the official lending authority has been called to make changes to lending regulations. Because I have to say, if these changes actually happen, they're going to have a huge impact on both mortgage holders and those that are looking to enter the market. So today, let's unpack exactly what's happening and the impact it's going to have. Right now, the industry body has been called to ease lending buffers as borrowers are becoming trapped in their mortgages. And ultimately, lending is the key to property prices because as interest rates rise, property prices fall. And looking at the data, it reveals just that. In this graph, we can see that in the blue is a housing finance commitments, and in the red, it's the 5 capital cities and their average price growth. Looking at the graph, we can see there's quite a correlation between the two. Essentially, as housing finance commitments increase, so too do dwelling values. And this isn't unique to Australia. Looking at what's happening in the US, there's the same or similar trend with house price growth in the red and mortgage debt growth in the blue. And we can definitely see that correlation again there because ultimately lending criteria is what drives property prices. The more someone can lend, the more they'll spend on property, and it's a cycle where more people continue doing the same as if reinforced by increased values. And that brings us back to the Australian Prudential Regulation Authority, also known as APRA, that there's concerns that with interest rates rising, that people will be trapped. And it's only recently that the regulator required the banks to increase their assessment buffer from 2.5% to 3%. And essentially, this is a buffer the banks will consider your repayments on. So if you've got a 3% interest rate, for example, with another 3% buffer, they'll assess your application with the repayment of a minimum 6% interest rate. And there's calls for this to be reduced as low as 2%. And having a quick look at exactly what these buffers do, we can see that right here we've got a 6% buffer and we can borrow about $1.1 million. Reducing that a full 1%, that increases it by more than $100,000, allowing you to borrow $1.24 million. And with the banks expecting around $500 billion in fixed rate loan about to expire over the next 2 years, there's big concerns and big calls for things to change. It's because when your fixed rate ends and you look to refinance, the banks will complete a reassessment on your application. So everything's the same as you applied 3 years ago, then the bank still may say that they can't help. And it all comes back to the assessment rate. Because as the assessment rate increases, whilst your circumstances might not have changed, then the amount the banks can lend to you, even though their criteria, nothing else has changed, will decrease significantly. And traditionally, this has been the case. When you look to refinance, the bank will have to complete a reassessment on your income, your financial position. Think of it like when you purchase a home. They need to make sure that you can afford the mortgage. For me, it's completely silly. But there are a number of lenders that will actually complete what's called a simplified refinance process, essentially not needing to review anything except your repayment history. Providing you're refinancing and not changing too much on your home loan, then they'll complete their assessment without any additional verification. And in my opinion, makes a lot of sense because if you've been paying your mortgage and you're simply going from one provider to another where your repayments will be lower because the interest rate's lower, then why do they need to complete a reassessment? And if you're looking to refinance, here at Hunter Galloway, we can help. We service Australia-wide and don't charge a fee. So hit us up on huntergalloway.com.au or call us at 1300 088 065. And here's an example of the new way of refinancing without necessarily having to worry about whether you meet the criteria, because not many people are aware of this. Even some industry experts aren't even aware of this new process of refinancing and not having to worry about necessarily meeting all the bank's criteria. So this is a simplified refinance process, and it essentially means you can refinance from one provider to another without having to go through the rigmarole of finding out whether or not you qualify. The first question they're asking is, has there been a significant reduction in any of the applicant's income since their last application? And it's a yes or no answer. Interest rates, confirm that the rates at the applicant's new facility will be lower compared to their current facility. And again, that makes sense. If you're refinancing a $300,000 loan from a 5% interest rate to a 4% interest rate, well then, if they're already paying their mortgage currently, what other things do you need to know? And because of ASIC, there are a few other things to keep in mind. Firstly, that the interest rate on the new facility must be lower compared to the other one. Again, makes sense. The loan to value ratio must be 80%. That the new limits can't be more than 5% higher than the existing, which means you can't be doing anything significant. The loan limit pretty much needs to be the same and no more. All facilities must have clean repayment history. And again, this makes a lot of common sense. If you're making repayments on a higher interest rate, then you won't have any problems to a lower, even though you might not meet the traditional lending criteria. The new facilities must be in the same names as the facilities being refinanced, and you can't be in any financial difficulty, or there can't be any foreseeable changes that'll make impact to your ability to make repayments to the mortgage. So if you know you're getting laid off, then of course you wouldn't be eligible for this. And while at this stage there are a few lenders that are able to offer the simplified refinance process, it essentially means that you're not locked in. So if you've talked to someone and you were trying to refinance and were told that they can't help, then don't give up, because the simplified refinance process means you don't need to complete any of the rigmarole, none of the assessment, and providing you can answer those questions, we'll be able to refinance on a lower rate without having to worry about the bank's assessment